Good afternoon. It's 4:15 here in Cincinnati, and we will begin chapter 16, 17, and 18. I know most of you did do video reviews on chapter 16 as well as 13, 14, and 15, but we'll discuss that at least briefly tonight so you can at least get my take on chapter 16. Not that it's that important, but it may give you some different ideas about what you'd already said. That doesn't mean to say that you need to do your video reviews or your reflection papers again. And then we'll get into chapter 17 and 18. Chapter 17 talks about financial accounting, and chapter 18, managerial finance. So let's look at the objectives for chapter 16. Identify the new and traditional tools that make the promotion mix, contrast the advantages and disadvantages of various advertising media, including the internet and social media, illustrate the steps in B2B and B2C selling process, business to business and business to consumer, describe the role of public relations departments and show how publicity fits in that role, assess the effectiveness of various forms of promotion, including sampling, and finally, show how word of mouth, viral marketing, blogging, podcasting, email marketing, and mobile marketing work. So let us get into this and talk a little bit about chapter 16. This is the promotion mix, and we've kind of talked about this before. We see the product in the middle. That's the most important thing. Of course, we could be talking about a service here as well. And then the four factors, if you will, or four facets of the promotion mix: personal selling, certainly being the most intense, sales promotion, public relations, and advertising. Integrated marketing. Notice the three tenets here of integrated marketing. Creating a positive message attached to the brand, meeting, and as we've said throughout the course, or at least as part in the marketing part and then earlier about product development, meeting but exceeding customer expectations, says needs here, but that's okay. And then meet the strategic marketing and promotional goals of the firm, whatever those happen to be. Now, here are the steps in the promotional campaign, and really, it's not a lot different from what we've already talked about in the past. First of all, you have to identify the market in which you intend to not only one, operate, but to sell your product or service. Define what you're trying to obtain. Have developed a budget for your promotion, a message that resonates, and it's a single message. It gives the same message time after time after time. Now, the message could change, and what I mean by changing here is you could vary it in some respects. Vary the pace, vary the intensity, vary exactly what you're saying, but the message remains. It does not deviate. Obviously, you have, this talks about a campaign, but that's a plan, and you have to implement that, and then you have to decide, has my plan been effective? What is it I need to do to change the plan to reach the market better? So those things are all part of what goes in there. This next slide just gives some classic campaigns that have resonated with people for a long period of time. The De Beers Diamond, the Marlboro Man, Does He or Doesn't She Clairol, and the Apple that I'm not too familiar with, although it says it's been around. Now, look at what advertising is here. We pay for this message, but it's not personal. In other words, I'm not delivering it to you, or someone's not delivering it to me in a face-to-face setting or in this type of setting, or perhaps by telephone. Now, I use those, and I'm excluding email, I'm excluding social media, where some of you may feel that that's not correct, and that's fine. But that social media often is certainly not personal. Email is always not personal. So we would have to think about this. The media that I'm speaking about now, or the medium I'm speaking about now, I'm talking to you, and if you had contacted, you had called in, pardon me, or were able to access GoToMeeting, and we could see your picture and your image, and you can see mine, and we can really interact that way because we're seeing each other and we're talking to each other in real time. So paid non-personal communication through various types of media, and we're gonna talk about some of those things. What are we trying to accomplish here? We're trying to inform the audience that we're trying to reach about the product. Then we're going to try to persuade that audience to buy the product, and we're also reminding them at the same time that we're still here, we're still in business, and we still want your business. This is kind of, in a way, what I've said before in some aspects, and some things, that this is kind of a gee whiz slide in a way. Look at the amount of money that's spent on advertising on a yearly basis. Now, this book was published at the beginning of 2016, or maybe right at the end of 2015. So that $215 billion figure that's up there probably is larger. And we know that this is disseminated through radio and TV and newspapers and magazines, etc. And some products will advertise on all, or use all of that. Some won't. Some will just use special ones depending upon the audience that they're trying to attract, or the audience that they're trying to reach, maybe just besides that. These are the major categories of advertising. I'm not going to go through that. And these are other major categories. What we're trying to do here. These are, advocacy, comparative, interactive, online, mobile, etc. And these are advertising expenditures by millions of dollars. And what we're talking about. And these are the types of advertising media that producers, manufacturers use. By the way, I'm using the word media here, and I want to make sure that you understand, because we often hear media used incorrectly. Medium is talking about one of these: a newspaper, television, radio. Media is speaking of all of these. Media is the plural of mediums. And so a lot of times when we hear people talking about the media, they may not be talking about all of the media, or all of a certain type of media, like all the television stations, all the radio stations, or all the networks, etc. And they actually are referring to a medium, but use the term media. You can look at your text at page 217, page 451, the different types of advertising and what it will do for you in respect. And it talks about TV. Of course, that's the most expensive right now, or has been the most expensive, traditionally been the most expensive in the last 50 or so years. Direct mail, outdoor, pardon me, which would be billboards and things of that nature. And then, of course, we have social media and things of that nature. What you will see in the figure 16.5 toward the bottom of page 451 is the advantages of each one of these and the disadvantages. I really won't go over each one of these to tell you, but newspaper comes at the top. Newspapers did for many years reach a lot of people. Home delivery was something that was everybody did. And today we know that that's drying up simply because producers, manufacturers, etc., want to use other types of media to advertise. And because of declining ad revenues, we have seen newspapers shrink in size, shrink in circulation, and in fact, some have gone out of business or are merged with other entities. So this just gives you an idea here, this particular slide, and the figure in the text, the types of advertising that is used, what is popular, what is not popular, what's cost, and what doesn't cost. Now, we have other things on television, for instance, that we see, and we also have things that are online and things of that nature. We have the infomercial. And infomercials have been around for a long period of time. And there's a segment that's bought on TV, and usually it's a half an hour. Sometimes it could be longer. And all it's talked about is that product and its uses, etc. Online ads are something entirely different. They're done to attract people to the internet, obviously, and to learn about a product, and then obviously to purchase a product. And notice the interactive promotion. The object here is to get the seller and the buyer to enter into a dialogue, just like you would do if you went to the department store and were thinking about purchasing a television set, or maybe to Best Buy. And by the way, I mentioned Best Buy. This is something that popped in my mind, not that I have any allegiance to Best Buy. Or you go to an automobile dealer to think about purchasing a new car, perhaps a used car. You're dealing with a person, somebody who's actually there standing in front of you, who can answer your questions. So that's the object of interactive promotion, to create a dialogue, to get people to do a give and take thing, just like you would in a normal sales transaction between you and a salesperson. These are things we talked about, online experience. We've seen some of this before about the site must be easy to navigate, etc. But look what users want here. They want something that's fast. They also want something that's inexpensive, although that doesn't come into play here. But they want something, it says readable sites, that you can read it easily, but I'd also say reliable sites, that the site is there, it gives you what you want, gives you the things that you need, and it's going to be there tomorrow and the next day and the day after. It may change somewhat depending upon circumstances and the message trying to be delivered, but it's there. I'm not going to talk about pay-per-tweet. Or that particular thing. Watch out for social scammers. That's something that you have to do. This is just something that Kraft is doing with Oreos. Here we have something that talks about global advertising, and it's something we need to think about. Global advertising is difficult because you are taking one product and you're trying to deliver a same message to the globe, to the world. And there's difficulty here because we lose something in translation. Now, what do I mean by that? Well, we have words that translate not well from English to other languages and vice versa. A classic example here was a use by the president of Russia referring to one of the presidential candidates here in the United States. Somebody said the word, said that he was brilliant, coming from the Russian president. But that word could be translated in different ways. That brilliance does not always attach the same meaning that was taken here in the United States, the Russian word for brilliance. And of course, we have words that we use on an everyday basis. Here and here just coming to mind, and there coming to mind, that we know are spelled differently and refer to things differently. Those are just two simple examples that I use. So those are the problems that we have, and you have to be very careful in dealing with that. Personal selling. Now, we said that advertising is not personal selling. Personal selling is exactly what it says. It is face-to-face. A salesperson is giving a prospective customer a pitch. Now, don't take that to be negative. I meant sales pitch is a common term. And he or she is not only promoting the product, saying this will do this, and they're trying to sell the product. And a part of that is, while the salesperson is going through this, he or she is trying to, at least sometime in this conversation, interactive conversation, find out about other prospects. Now, the key to this next bullet is the salesperson listening. We have one mouth and two ears. So that should tell us that it's more important to listen than it is to talk. Unfortunately, we don't always do that, and we are so interested in formulating our response to what's being said, we don't hear what's being said. Yeah, we do hear, but we don't listen to it. That's a better way to say it. So we don't get it into what's going on. What we have here is the 6 steps, if you will. 7 steps is mentioned here, and that's important, but that's a little bit different. This is in the selling process. So the first thing we have to do is find a prospect, and at the same time in finding a prospect, ensuring to the best of our ability that prospect has the necessary means to purchase what we're trying to sell. So we have couple things here. We have what's known as a pre-approach. We sort of go up and get started, etc., and then we do the actual approach, which is the beginning of the sales pitch. Then we actually make the presentation. Notice what we do next. We answer objections. Now, in answering objections, it can be actual objections that are given to us, or ones that we think might happen, and so we answer those and say, you may be thinking about, and we answer that and saying, hey, I'm on the same page as you are. Once we've done that, we close the sale, and we do closing the sale in some fashion, like we can deliver this to you on Tuesday next week. We have the product in all these various colors. Which one would you prefer? That's the closing. Now, notice what actually comes before the closing is something that's called a trial closing, and that would be what I said to you. Would you like this delivered next Tuesday? We have this in every color that you can imagine. What color would you choose? What suits you best? And this moves the person along toward making a decision, hopefully favorable, in buying the product. Now, part of what I said may not be actually a good thing to do. You might make a suggestion and say, I think blue would be a good color for you. We have a delivery truck in your area Tuesday. We can deliver it to your house at 2 or 3 o'clock in the afternoon, whatever it happens to be. And then this last part is very critical, especially in a big ticket item like a piece of furniture, a television set. Some people would say it's a piece of furniture, an automobile, etc. It's following up with that person and finding out how well he or she is satisfied with the purchase that he or she made. Now, this particular thing, slide talks about prospecting and qualifying. And I think we need to look at this just a second here. Here, what it says, notice it says we have to do whatever research is necessary to make sure that person is qualified, has the resources to purchase the product. And, you know, that's kind of difficult when somebody walks up to you and said, you know, I'm interested in this model car. Now, you would think that when a person says that, pardon me, he or she is qualified, that may or may not be the case. So you need to ask some kind of questions. Maybe you do want to say what kind of car you have to trade in, or you're interested in a trade-in, or something of that nature, so you can get some kind of an idea of whether the person is really interested in purchasing and has the means to purchase. And notice this part of the second bullet has a willingness to listen to the salesperson make his or her presentation. So this is the prospecting part. This is the qualifying part, the first two bullets. And then the prospect is actually the person that has the physical means to finalize the purchase. That slide before, let me go back here. Some of the things you want to do to differentiate yourself, know your competition, and sell to people who are most likely to buy. Obviously, you don't want to spend a lot of time on talking to people that are not going to buy something. That just takes too much time. And then, you know, you need to make sure that you're actually providing something to the person, that the sale, being a salesperson is more than just being a job. Be honest and make sure that you're building relationships. Now, the business-to-business selling is a little bit different than personal selling. Yes, it's still personal selling, but when you go into this, the people that you're calling on, for the most part, by the way, this slide can be seen at figure 16.6 on page 459 at the top. You already pretty much know that these people have the ability to buy. So you're not making a pre-approach here, you're making an approach. And so you've cut out that one step. Ask questions, make your presentation, close the sale, and follow up. The only difference I would tell you here is make sure that the person you are talking about is the person authorized to buy. Not that he or she has the resources, it's the company that has the resources. But this person is authorized to make the purchase. And be careful here, because many of these people have an administrative assistant. And that person typically is known as a gatekeeper. And if you need to get in to see that person, it's best for you to be on the good side of the gatekeeper. Otherwise, you're not going to get in the door. All right, let's move on here a little bit. Public relations is different than advertising. Public relations is trying to take the pulse of the community, if you will, and trying to find out where they are and develop something that's going to resonate with them. So here are the three things that you want to do in a good PR program. First of all, you have to listen. And we talked about that before, something that's going to continue here. and it won't change. Then you have to have something set up, a plan, if you will, that will change policies, perhaps rules, perhaps regulations, perhaps procedures. Now, rules and regulations are a little harder to change than policies are. So you have to see where you are and make sure that you're right people. And then you want to tell the people who you're trying to make a pitch to that you're going to respond to what it is that they're looking for. Publicity, on the other hand, is different. Publicity is information that is provided to someone else to tell the general public about something, to give them information about a product. Notice what's in there. This is not paid. So what happens here is you type up a public relations release about a product and you send it to a newspaper or you send it to a television or radio, and you're asking for them to publicize this particular type thing. So notice again, not paid, so it's not paid, it's free. It's going to reach an audience that would not normally, use that word again, normally, not normally pay attention. Now, there are a lot of things that appear in a newspaper that are what are publicity type things that my wife reads all the time and I seldom read. So, you know, maybe they're trying to reach me and they're not. Now, sometimes you're advertising for bids and things of that nature, and that's also publicity. And look at the following bullet. Because it is given over the radio or seen on TV or printed in a newspaper, it tends to be more believable than advertising, although we could really say it is advertising in some respects. Now, yeah, there's some, those are distinct advantages, but there's some distinct disadvantages. You send that release out, you don't have any idea when it's going to be broadcast, telecast, or printed in a newspaper. And because you don't know that, what you get back, it could be good or bad. I mean, it could get to where you want it to get. It could be automatically not paid attention to. And once it's been delivered, it will not be repeated. Now that changes what I said on what the slide says. It says likely not to be repeated. I can pretty much guarantee you that it will not be repeated. Sales promotions, this is something that companies do to get people interested in the product and obviously hope that they'll buy it. We have two kinds. We have business-to-business sales promotions and consumer sales promotions. Now, here are some sales promotion techniques. Business-to-business, we have trade shows, catalogs, conventions, etc. Business-to-consumer, coupons, sampling, premiums, etc. There's other ones as well. I'm just giving some that most of us are familiar with. That just gives us a different display of what we just talked about. I'm not going to discuss that slide. One of the great types of promotions that any company can have, regardless of its size, is word of mouth. And it is important for the ones that we see here at the bottom. Really important because they depend on foot traffic and they depend upon their customers telling other customers how well they felt about them. And I'll just give you an example. There are friends of ours that we go out to dinner with on occasion, and we've gone to a place that my wife and I like very well, and we tend not to go with them because they tend to be very critical. And the staff knows that. It puts the staff on notice, et cetera, et cetera. So while my wife and I might say we really had good service and so on and so forth, they will tend to denigrate that. And I'm not talking about a fast food restaurant. I'm talking about a high-end restaurant. But the restaurants don't need that kind of negativity. So, we try to minimize that, at least on that particular occasion. It's a place we like to go and we like to return. This is just talking about sites and review sites like Yelp and things of that nature. I'm not going to spend a lot of time on that. Viral marketing, we know what that is. People do pay a lot of attention to it. We have to be careful with it and careful of use of it. This is the same with blogs and podcasting, email promotions, etc. Again, using mobile devices. And finally, a couple of types of strategies to get the product out. A push strategy means we're pushing the product out. We're using as many promotional tools that we can do to get products stocked on shelves. That's the point here, stocked on shelves. Whereas a pull strategy, we're using advertising to get people to come in to request a product. Now, I'll give you an example of this. There is a product called Claritin that's supposedly, if I remember correctly, it's for allergies. I don't use Claritin. I don't own stock in Claritin. I have no bones to pick with Claritin. But Claritin became a #1 seller simply because of this pull strategy, getting people to request it from their physicians, because at one time you could only get Claritin by a physician prescription. Even though there was a research to say that Claritin was no better than any of its competitors. What happened was this strategy that it used, getting people to request the product, now this says from retailers, I'm talking about physician here, worked. So that's what they were trying to do. That's what made it effective, etc. You can probably think of other ones as well. As I said, data that I saw said it was no better than its competitors. Didn't mean it was bad product, it just wasn't any better. A pick, obviously, is that what it says. People get to pick their own. Well, we've reached 448. We've completed chapter 16 on promotions and advertising. We're going to take a short break. We'll come back at 4:51, and we will discuss chapter 17. Please come back at 4:51, and we'll do understanding accounting and financial information. Thank you. All right, 451, Chapter 17, Understanding Accounting and Financial Information. Learning objectives for this chapter are to demonstrate the role that accounting and financial information play for a business and its stakeholders, identify the different disciplines within the accounting profession, list the steps in the accounting cycle, distinguish between accounting and bookkeeping, and explain how computers are used in accounting. Explain how the major financial statements differ, and then finally demonstrate the application of ratio analysis in reporting financial information. All right. What is accounting? It's a pretty simple definition. You can see it here in your text on page 474 on the left-hand margin. It is simply recording and classifying. And then notice here summarizing, put it in capsule form, if you will, and interpreting financial transactions of a particular organization. And that information is provided to interested parties. Now, financial information, financial accounting is usually for people who are outside the organization. Although we do see people here, notice here, we're talking about the employers, owners themselves, employees. But then we have people like creditors, unions, investors, government, especially if it's a public traded organization, because they can tell the health of an organization by looking at its financials and its financial accounting. So that's what accounting is. And this is the accounting system. Pardon me. You can see this graphically displayed at the top of page 475, figure 17.1 in your text. And I'm not going to go through each of these, but notice we're here talking about things we talked back in the production cycle, and operations cycle. Inputs goes through some kind of transformation. Here we call it processing, and then we have outputs. And then the outputs are our financial statements, the balance sheet, income statement, statement of cash flow, etc. So the inputs are, things that we need: sales documents, shipping, payroll, etc. And then the processing is recording this information, journals, etc. These are the accountant's responsibilities. Notice here that cash management and forecasting, strategy and planning, tax auditing, valuation, etc. Now, managerial accounting is somewhat different. Maybe somewhat is not a good word to use. Maybe it's radically different or demonstrably different. Here, we're using this information to help managers make decisions, both financial and otherwise. Now, notice what managerial accounting is involved with. It tells us what our costs of production are, and marketing. Helps us prepare budgets. And then finally, if we use the information properly, can help us minimize tax liabilities. Now, I want to stress here, when we talk about minimizing tax liabilities, this does not mean somebody is skirting the law. It is simply saying I'm taking advantage of what information I have, what deductions I can take, et cetera, to minimize the amount of tax that I am required to pay, or my company is required to pay. Each of us does that when we file our 1040 at the end of the year to pay the IRS. We are allowed certain deductions for a mortgage, for some type of, perhaps some type of loan that we have that we're paying interest on besides a mortgage, for charitable deductions, for business deductions, and things of that nature. For instance, if you're a salesperson and use your automobile, your company does not supply automobiles, use your automobile. As long as you're using the automobile for business, you can deduct a certain percentage of, of operating your vehicle. And that is perfectly legal. Now, I want to digress here just a second and say that there are a lot of people complain about our tax system. We probably do have too many loopholes in our tax system. And if you look at the IRS regulation, it runs to, close to 1,000 pages or more. Now, by the way, and for the most part, those regulations are not written by the IRS. They're written by Congress, or Congress directs what has to be written. So we need to think about those things. And minimizing tax liabilities does not mean somebody is not following the law and paying their taxes, or simply saying, I'm taking advantage of things that are given to me. And this is the users of the report for accounting information that we talked about. Governments and regulatory agencies and other people interested, and then of course people managing the firm. And by the way, this is can be seen in Figure 17.2 in your text, again on page 475. Now we're going to spend some time here speaking about financial accounting, and here we give you some kind of an idea. Again, it's analysis is generated primarily for people outside the organization. Not to say, as we said early on, that it's not going to be used by the owners, pardon me again, and other interested inside parties. These are the questions that the financial accounting attempts to answer. Is the organization making money? State a little bit differently here, but that's what you want to know. If you're in business to make a profit, you have to make money. If you don't make money, you're going to be out of business pretty quickly. Now, somebody will say, well, some companies show a break even at the end of the year. Yes, that may be true. But if you continue to break even, you have to question how long you're going to be able to stay in business, because the cost of doing business doesn't stay the same, and the cost of raw materials does not stay the same. Can we pay what we owe? Very important. Is our debt too high? Now, a lot of times debt's taken on to do other type things, but we have to be able to pay what we owe. Now, we may only have to be paying interest on what we borrowed at the present time, but sooner or later, we're going to have to pay the whole bill, or we're going to have to restructure our debt. So we need to know that. And then this last down here is, I kind of combined it with the previous statement, is that's how much do we owe? What's our outstanding debt? That could come in the form of bonds or whatever. Of course, we'll talk about bonds a little bit later, but that's what we have to do. And then companies, if companies are publicly traded, they're doing this once a quarter. And then if they're also going to do an annual report, and the annual report not only summarizes what's going on in each of the preceding quarters, but it also gives us some forecast of what the firm expects to be able to do somewhere down the road, next year, 2 or 3 years from now, etc. Now, these are the tools that we need to have in front of us when we're trying to read and understand the annual report. All of these are important. And perhaps the two most important ones, besides the other ones that gives us an idea of the cash, their balance sheet and statement of cash flow, etc., are the first one and the second one, and the last one, excuse me. Discussion of management's giving us some kind of an idea of what the organization is doing. It uses the word analysis here, and that's fine. What it's doing, how it's progressing, et cetera, et cetera. The last one is also important, although there's some trouble with that, and I'm going to explain this, and that's the auditor's opinion. The auditor's at the end of doing the financial accounting statement is going to say, this is what we think. Now, why do I say there's some problems with that? Well, if the auditor is independent, then that means there should be no issue. If the auditor is not independent, which normally happens, and I'll explain that again in a second, then we may have to look at that with a jaundiced eye. Auditors normally are hired by the company, and assuming that the auditor has free and unfettered access to all the financials, and his or her fee, or his or her organization's fee, is paid up front, then we shouldn't have any consideration either. But if that auditor is hired by the company and the auditor does not have free and unfettered access, then we don't know how objective that report is. This is the difference between public and private companies. Private and public accountants. Private accountants usually work with one firm, and public accountants provide accounting to various individuals and businesses, or both. Certified public accountants, CPAs, are those folks who not only have passed a series of exams, but they also hold college degrees, and they have taken X number of credits over and above what is required to earn a bachelor's degree. That doesn't necessarily mean they have a master's degree, but they're over and above. In Ohio, for instance, you have to have, I used to know this off the top of my head, I may be wrong now, but you had to have an additional 30 hours in accounting over and above earning a bachelor's degree to be able to sit for the Certified Public Accountants examination. By the way, it's a very difficult examination, and it's not something that you walk into and say, well, here I am, I'm going to take it and expect to pass it. It's very difficult. These are different accounting practices, which we're not going to spend any time on. This particular slide talks about the Dodd-Frank Act that really doesn't affect most of us because it really affects banks and Wall Street. The act was brought about by the financial meltdown that we encountered and actually manifested itself in 2008, but started in 2007. It's interesting to learn that many of the banks and lenders on Wall Street and Wall Street firms have been fighting this for a long period of time. They're trying to weaken it, and I think we'll see some concerted effort either continue or diminish depending upon the outcome of this year's presidential election and which party controls Congress. These are auditing checks. Auditing is done for a, it's kind of like a check and a balances. Notice what they do. Auditors auditing review and evaluate information used to prepare the company's financial information. Independent auditor. This is unbiased opinion with what you're hoping to get here. There is an outfit known as the Certified Internal Auditors, CIAs, not to be confused with the Central Intelligence Agency. Notice here, these are people who earn or who hold a college degree and have 2 years experience in internal auditing, and then they have to take an exam and pass it, and it's administered by the Institute of Internal Auditors. Fraud damages business. I'm not going to go into this, but this is something that is very serious for any business to be concerned about, regardless of its size. And you have to be concerned about fraud. Tax accountants, these are people who are trained to prepare tax returns and in some cases to help people with tax strategies. And then we have government not-for-profit accounting. This is a little bit different. Every nonprofit has to file a financial accounting statement. It's a little bit different, and most of them have to file it with their state and then file a federal return as well. Now we're going to go to the accounting cycle, and this is you notice here a six step cycle that people go through, companies go through in doing their accounting. We can see this graphically displayed at the top of page 480 in figure 17.4. So first thing we're going to do is we're going to analyze the documents. Those are the inputs. Remember this? We talked about before. Then we're going to go through the processing part. Recording transactions. We're going to transfer that to a journal, a ledger. Then we're going to take a trial, trial balance. And that again is part of the processing. So our inputs, we're doing processing, and now we're going to do outputs. And the outputs are the preparation of 3 different types of financial statements: the balance sheet, income statement, and the statement of cash flow. I want to stop here just for a second because I'm looking for something, and then we'll come back to it. Yes, all right. Make sure we have this. Now, the next thing we have here, and we're now still talking about inputs, and that is the bookkeeper. Now, the bookkeeper is not the accountant, although the bookkeeper could be an accountant. And the bookkeeper's primary responsibility is to record the transactions. And the transactions have to be placed into meaningful categories so that people understand what they are or what they represent. Then they're going to be recorded in a book known as a ledger or a journal or the computer program. Same thing. Then we go through what is known as double entry bookkeeping. By the way, this practice has been around since somewhere in the 1400s, so it's not new. And the bookkeeper is recording the transactions in 2 places. This is like a check and balance. And hopefully, by being in 2 different places, we'll know it will be accurate. I'm not going to go into this slide a whole lot, but this really talks about computerized accounting programs, especially for small businesses. It is very important for a small business to keep track of its cash flow, balance sheets, etc., because undercapitalization and not doing proper financial controls is a prime reason that many small businesses fail. All right. Let's move ahead here. Now, these are the financial statements. These are the outputs, if you remember. I talked about a minute ago, inputs, processing, and outputs. And there's 3 key financial statements of the business: with the balance sheet, the income statement, and the statement of cash flow. The definitions for each of these can be seen at the bottom of page 481. The balance sheet tells us how healthy we are on today's date or some other specific date that you want to use. The income statement tells us about revenue. What's come in, what's gone out, how much money we have, whether it's a profit or loss, again, for a specified period. Now, for a small business, it could be weekly, monthly, etc. For a publicly traded business, it has to be reported on a quarterly basis. And then the statement of cash flow simply tells us how much is coming in and how much is going out. So it's what's coming in receipts, what's going out in payments. This is what is known as the fundamental accounting equation for the balance sheet. And it has to be balanced. And the formula is assets equal liabilities plus the owner's equity. And you'll see this equation done for you in the middle of page 482. Sorry, okay, here we go with assets. Assets are things that are owned by the firm that can either be tangible or intangible. Now, intangibles like goodwill, a brand name, a logo, a patent, something like that. Those are intangibles. You can't put a dollar figure on them. Liquidity of assets refers to how quickly those assets can be turned into cash. Now, here are how I've talked about some of this, talked about the intangibles, current assets. Notice something that I can turn into cash within a year. Fixed are things that are permanent, land, machines, buildings, etc. Those are fixed assets. They're not going to go anywhere. Now, we have to also classify liabilities. And a liability is simply what I as an owner or you as an owner owe to someone else. We have accounts payable. That's current liabilities. This is something that I purchased on credit. Now, please don't take that to mean I'm not going to pay for this. But if you use a credit card to pay for something, that's exactly what that is. I paid on credit, and I have to pay the bill. I have to pay it what I owe when the bill comes due. So that's the credit part. Pardon me. Notes payable, usually short-term, long-term. I've said I need to borrow this money. You're going to lend it to me, and I'm going to pay you back by a certain date. And in bonds payable, same way. These, however, tend to be long-term liabilities where notes payable can be either short or long-term. Owner's equity. This is what belongs to the owner minus anything he or she owes. And retained earnings are exactly what they say. This is what I've taken in because I've been profitable and I've plowed that back into the business. Bought more equipment, bought more raw material, whatever that happens to be. Now, the income statement, the best way to say this is to look at the one operable word, or operable phrase, excuse me, two-word phrase in the third line, the bottom line. Am I profitable? Do I have a loss? Or am I breaking even? Net income, net loss, the revenue left over after costs and expenses. If I'm on the plus side, I have income. On the minus side, I have a loss. Now, here is the formula for the income statement. And you can see this graphically displayed at the bottom of page 486. I start off with revenue. In other words, that's what I've taken in, minus the cost of goods sold. That equals what's known as my gross profit. Then I have to take operating expenses out of that, and that gives me my net income before I pay tax. And then after I've paid tax gives me the bottom line, either a plus or a minus. And this is just going back over what we have said here a different way. Revenue is what I've taken in. Cost of goods sold or manufactured, exactly what it says. Gross profit or gross margin. Gross margin means if you have gross profit or gross margin, you're showing a plus side here. Otherwise, it would say gross loss. And then we need to go beyond this. Just a second here. Yep, went too far. Pardon me. Income statement. All right, we're there. I need the next slide, which I think I missed. Okay, now we have to value our inventory. So we get something on here. Notice that what this says here, we have this thing known as the Generally Accepted Accounting Principles, GAAP, G-A-A-P. Permits accountants to use different methods of accounting for inventory. Now, I want you to listen to the fact that using a different method does not mean one is better than the other. What it simply means is if you use one, you have to be consistent and use that one all along. You can't switch from first in, first out to last in, first out, because the evaluation, whichever one you're using, affects both income and the valuation of the inventory. So it doesn't make any difference which you use. What does make a difference is that you use one all the time and don't switch back and forth. We're still going on here. We're talking about operating expenses. Obviously, that's what it costs us to do business. That is paying salaries, that's rent, that's payment of utilities, supplies, et cetera, And then depreciation is something that we can write off on tangible assets. Usually we're talking here about machinery, and there is normally a schedule of depreciation that is followed. Now you can bump that up, and when I say bump that up, you can accelerate that depreciation. In other words, if something's supposed to depreciate over 10 years, you can depreciate it over 5, and that's fine. That's okay. But you can't use those last 5 years. Now, statement of cash flow, this tells us what we have on hand for operations, for investments, for financing. And cash flow is simple. It's the difference between what comes in and what goes out. And it has to be managed well. Excuse me, let me move on here. There are four kinds of ratios to use, and I don't want you to get too confused about these because they can be ratio analysis. They can be kind of confusing. This is just assessing a firm's financial condition and using some type of calculation from the financial statement. So we have liquidity, leverage, performance, and activity ratios. This is the most common, liquidity, and it's the ability to pay its bills and to turn its assets into cash and pay short-term debts. So under this, we have the current ratio and the asset test. I'm going to find this information on the balance sheet. The leverage measures the degree to which the firm relies on borrowed funds, and the cash rates and the key ratios here are debt to owner's equity ratio. Again, information found on the balance sheet. You go back here from this. Profitability ratio measures how effectively we're using the various resources to achieve profits. And here we have the key ratios: the basic earnings per share ratio, return on sales, return on equity. And we find this information not only on the balance sheet, but also on the income statement. And we have the activity ratios, how effectively we're turning over the inventory. And if you don't turn over inventory, you're paying for it. Sitting on your shelf, you're paying for insurance, you're paying for utilities to heat it, perhaps, etc. So here, the key here is the inventory turnover ratio. We find this also on the balance sheet and on the income statement. And finally, multinational companies have to adapt accounting rules for various countries in which they operate. Many countries have adopted what's known as the International Financial Reporting Standards System. The U.S. Securities and Exchange Commission believes it should be a standard that is in the United States that is still up for discussion and has not been decided. We've reached 5:23. We're finished with concluded chapter 17, and we're going to take a break. And please come back at just turned 5:24 at 5:27. Please come back at 5:27. Thank you. All right, it's 5:27. We are back here with chapter 18. And to ensure that we get to ask the lecture discussion questions for this week before we run out of time, the question is, what are the advantages and disadvantages of debt financing? And what are the advantages and disadvantages of equity financing? So in your own words, what are the advantages and disadvantages of debt financing? What are the advantages and disadvantages of equity financing? Chapter 18, Financial Management. The learning objectives for this chapter are explain the roles and responsibilities of financial managers, outline the financial managing process, and explain the 3 key budgets in the financial plan, explain why firms need operating funds, and finally, identify and describe different sources of short-term financing, and finally, identify and describe different sources of long-term financing. Now, the question posed here is, what is finance? Notice here what it says is the function in a business that acquires funds for the firm in some fashion and then manages them. Finally, we don't need to go to that last piece over there. The financial activities performed are preparing the budgets, and there are 3 major budgets, which we'll talk about a little bit later, creating cash flow analyses, and then finally planning for expenditures. And financial management is simply managing the organization's resources in such a way that the organization is able to meet its goals and objectives. Now, the only thing it doesn't talk about here, pardon me, is it doesn't break that down into human resources and other resources. But in some fashion, those resources are going to be managed just as well. These are what financial managers are responsible for doing. And by the way, these different functions may be split up amongst various and sundry people, may not necessarily be the same person or persons doing all of these things. But you're paying what's due, you're collecting what's due, you're making sure if you're a large company, you know what the markets are doing because you're going to be investing in the firm's assets in some fashion to try to one of 2 things, either secure loans, pay loans off, or just to increase the firm's financial standing. And finally, you're assuring the accuracy of the reports that you've rendered or had rendered on your behalf. This is just simply a who's who in finance, so I'm not going to go over that. I'll just put that up for you to see, and we're going to try to move on here just a little bit. Now, we can see this particular slide depicted figure 18.1 at the top of page 505. And this is what financial managers do. Notice they audit, they plan, manage the taxes, procure funds, control funds, collect funds, etc., do budgeting, and not only do budgeting, but prepare budgets. So these are all the things that financial managers do. And as I said before, these functions may be parceled out to various people within the finance department of the organization. These are things that are always on the minds of financial managers. So some concerns that they have. People are going to buy our products. How's the market doing? We're going to have to pay more money for borrowing. How's the dollar doing today? As we know today, right now, I'm not sure what happened today, but the dollar is in a very strong position. And it's causing a lot of firms some angst because it's making our products more expensive overseas. What kind of competition do we have? Is a competition only internal, being within the United States? Is it external? Is it both? What about environmental regulations? They're going to have some impact on us. And there's a lot of, as I've said before in this course, there's a lot of yin and yang about environmental regulations. Those people say we need them, but we may not have enough. And there's other people say we have too many and they're doing us a lot of harm. One of the things we have to look at, as far as I'm concerned, is that we have to stop and think, first of all, we only have one planet. We need to do whatever we can to maintain it. We know, whether you believe in global warming or not, that the ice pack in the Arctic particularly is melting. And it's melting in Greenland much faster than what we thought. Now, I'm not talking about global warming. I've not mentioned global warming one time in what I just got through saying. Something is causing it. And what is it we can do to maintain what we have now and not make it worse? Why are we concerned about that? Well, because we have a lot of valuable property in the United States alone that sits very close to oceanfront. And if we have melting ice cap, that's going to raise the level of our oceans. And if it raises the level of the oceans, we're going to have problems. We're going to have streets flooded. We're going to have buildings flooded, etc. Now, you don't have to believe me, that's fine. But we already have these conditions in places like Norfolk, Virginia. And by the way, I used to live in that general area, and I didn't live in Norfolk. I lived in Newport News, it's about 30 miles away. And I had a son that worked there for a while in Norfolk. And I've been there, I visited. And that's been some years ago. And I saw what I'm talking about today. So we have to do things that, make sense for us. And think about these and don't stick our heads in the sand and say, well, this is not going to happen. These are the reasons businesses fail financially. Don't have enough money. Don't know where our money went. We couldn't even tell you today where our money was today. And we don't control our expenses. So money is always an issue in a business. And that's something we really have to be concerned about. This particular slide kind of goes back to some things we talked about some while ago, and I'm not going to go over that. Financial planning. This is what the financial managers have to do. They have to analyze a company's short-term and long-term monetary needs, and also short-term or long-term what's coming in and what's going out. Now, I've talked about short-term and long-term monetary needs, which is different than short-term or long-term what's coming in and what's going out. And the reason I say that is because sometimes it's better, and the cost of doing business, to borrow money, even though we know what's coming in and what's going out. So there are two different situations we have to think about here. And as we look at this, these are what we do in financial planning, and I kind of talked about this. The first bullet, what's coming in, what's going out, but then we have to develop budgets that address those issues. And then we have to have some kind of controls in place, and here we're talking about finances, to make sure that number one, we're achieving the goals that we want to achieve, but number two, that we're managing our money well. We know where it goes. We can account for it, and we're not spending more than we're taking in. So that's financial planning, but we also have a thing called financial forecasting. So we have short-term cash flow and long-term forecast. Short-term is what the company needs for a year or less. A cash flow forecast simply tells us what we believe is going to come in and go out in the future. And look what the future talks about here, months and quarters. So if we want to transpose that, we're going to go back to the short term and say we're talking about a year or less. And then long term is something that is more than a year and could be as long as 5 or 10 years. Budgeting. And this is what we really have to pay a lot of attention, because know what this is. This is expectations. Now, this is also a forecast in a way, because it talks about what's coming in and how we're going to use what's come in, how we're going to allocate what's come in for specific reasons. Now, there is always an issue here. But allocation is, we need to put our money where we're getting the best return for our buck. And the resources are scarce, so we need to maximize that. We need to put it someplace where we're going to get our maximum return. So we have to pay attention to the balance sheet, because that's going to tell us how we help develop the budget, income statement, statement of cash flow, and then the forecast that we made, both long-term and short-term. Remember that the budget is a guide. If you prefer to use the term blueprint, that's fine. We can do that. And that's exactly what it is. It tells us what we think is going to happen, and we have to pay attention to that. We have 3 main budgets, capital, cash, and operating, or master. Capital is what we're going to budget for high-ticket items. High-ticket items that are going to cost us a lot of money. Cash budget goes back and talks about cash inflow and outflow during a particular period. Again, we specified for the most part that's either a month or a quarter. And the operating or master budget ties the other budgets together, and it is a summary of financial activities. This particular slide depicts financial planning. And it just really talks about what we just got through talking about. You can see this graphically displayed, figure 18.2 at the bottom of page 507. And we're not going to spend any more time on it than that. But here's the big issue here we have to establish financial control. Very, very, very important. And here what we're doing is we have something in place that allows us to examine what is actual versus what we projected, and also actual versus costs and expenses. So it gives us a twofold picture, if you will. What's actually occurring versus what we expected to occur. And this is what we're trying to do here. Are we meeting our short-term obligations? Do we have enough money coming in? How are we financing? And then are we receiving a good return on our investments? This particular slide tells us what we need here in a way of being able to manage our funds on a day-to-day basis. We have to control credit. We have to get the inventory we need, and of course then we have to make capital expenditures to improve the business and move it forward. How do we do that? How do we manage this? Well, we can, try to get our bills, our collectibles in quicker. We can offer people a discount for paying early. Uh, excuse me here just a second. I skipped a slide. Obviously, we can do something down here that we should be careful about doing, and that's raising prices. May be something that we have to do, but we really need to stop and think about that. Now, there's two ways that we can get money. One is through debt financing. Here we're going to borrow money, and we know that we're going to have to pay it back. And then we can do equity financing, which is we're raising funds through things like the sale of stock, etc. And that's not going to cost us anything. Now, the downside of that is it may devalue the stock if we sell more of it. And then it may also change the complexion of the ownership. If we sell a lot of stock, it means the ownership may increase or decrease depending upon who's buying the stock. Now, short-term financing, we've talked about this before, and I'm not going to go through that. First, long-term financing. Now, why do we need funds? Well, if we look at this particular slide, which you can see at the top of page 513, figure 18.5, we may need to pay bills because we had a shortfall in revenue. And that would be cash flow problems. We may have had some type of emergency. We may want to expand our inventory, and we may have other reasons. And long-term can be new product development, mergers, acquisitions, etc. We want to move into a new facility, or we're building a new facility, or we're adding on to the current facility. All sorts of things like that. Why we need to borrow funds to continue to operate. We can do things for short-term financing, trade credit, buying something now and paying later. Matter of fact, most companies do that. They buy today and say terms of business is normally net 30 days. We're going to sell you this, you pay us back in 30 days, we're fine. Some may even, to increase getting money coming in, may offer a credit, 1% in 10 days. Net 30, 1% in 10 days. That means if you owe a bill of $100, you take 1% off, you're paying $99, you pay within 10 days. So 2% would be obviously a little bit higher than that, a little bit better. And then we can do things like promissory notes, exactly what it says. You lend me money, I promise to pay you back at a certain time. Now, here we're talking about certain types of short-term financing. You can do things like, especially if you're a small firm, get money from family and friends. That's really always difficult to do, especially from family. There's a business transaction, and most people don't like to do that unless they have to. If you do that, notice what it says. Have specific terms. Put it in writing, and arrange for repayment just like you would anything else. It's something that you really need to do when you're borrowing from friends and family, especially. That's a good way to ruin good family relationships and to lose friends. I'm not saying it doesn't happen, but you really have to be careful when you do things like that. Banks like to do short-term lending, especially to larger institutions, because they're pretty well convinced they'll get their money back. It's been very difficult through the since the beginning of the financial crisis 6, 7, 8 years ago, 9, 10 years ago now almost, that small businesses have been able to get conventional loans. I'm not going to talk about this particular slide. Now, here's the type of loans that you can get from a bank. Secured loans. That means that you're putting up something to secure the loan, and it's usually property. Class says collateral, it's usually property. Unsecured loan, there's no collateral required from the borrower. A line of credit is the amount of money a bank will lend you up to a certain amount that funds that it has. And then revolving credit agreement, line of credit that's guaranteed, but there's a fee associated with it. Now, other ways to get business is one thing here is called factoring. And that is selling accounts receivable for cash. Now, once you do that, if you go into factoring, you're not going to get 100% face value. So if you have an account receivable for $1,000 and you sell that to somebody who's in the factoring business, you can expect to receive $800 or $900, maybe less, maybe a little bit more than 900, but certainly you're not going to get. Now, why? Well, that person that's doing the factoring has to make some money. So he or she figures, well, now wait a minute here. If I buy from you, I might be able to get $900 back. Okay, that's what I'm going to do. You sell it to me, I'll give you $800. I might be able to get 900. If he or she thinks they can get the full face value and you need the money, you can say, okay, I'll give you 900. So they charge more, but remember, and you look at it this in a way of a loan, and as an example, not actually a loan because you're going to walk away with the money, but it's type of a loan because you're getting money quicker than you would normally if you waited for the buyer to pay. Commercial paper, notice that this is an unsecured promissory note, usually in amounts of $100,000 or more, and it has to be repaid within 9 months, 270 days. Notice the next thing. This is unsecured, and so unless you have sterling credit rating, you're not going to get commercial paper loan. Credit cards, you just really have to be careful about using credit cards if you're trying to finance yourself. I mean, these things, they'll eat your lunch. As an example, I used to listen to a money show when I was stationed in the Army in the Washington, D.C. area, and this goes back a number of years. If you have a $1,000 balance on your credit card, and you only pay the minimum due. Now remember, I'm talking about something that was told to me around 20 years ago, or I listened to about 20 years ago, so it's probably changed. If you only paid the minimum balance due each month, you would not be able to pay off that $1,000 credit for 10 years. So that's what I'm talking about. If you're using credit cards to help finance your business or help run your business, to borrow money, especially if you're a small business, be very, very careful about doing that because it is not inexpensive. We're going to skip those two. Well, we're going to come back here. Here's how companies can start to raise capital. I'm not going to talk a lot to you, but if you're doing business with vendors, you might say, hey, how about lending us some money? Because that may be a way to get money. Here's the way businesses fail to raise capital. They don't have a business plan. Don't know how much to ask for. And if they do know how much to ask for, they can't say what the money is going to be used for. don't have a good credit rating, and then management is just unrealistic about what's going to happen. Now, we're going to move here toward the last part, and what we're saying here now is setting long-term financing objectives. What we have to know what our long-term goals are, but we don't know those, we can't set the objectives. What funds do we need? We don't want to take more funds. We don't want to ask for more funds than what we need that we're going to be able to make the long-term goals and objectives. And where can we get this? What's available? What's going to best fit our needs? Do we need to buy bonds? Do we need to do equity? What is it that we need? These are the 5 C's of credit. We're getting off just a little bit here because I'd like to follow on with where we are, but this gives us a good idea. What kind of character do we have? Can we repay? These are the 5 C's, but I'm going to put these in different words. Is what we're borrowing going to be invested back in the business? How's the economy? Is it going to allow this person to be able to pay back? And what can he put or she put down as good faith to back up this loan, collateral? Long-term financing. Again, we talked over 5 years. This slide says 3 to 7, but could extend to 15 or 20. Loan agreement, that's the promissory note that the lender and the borrower sign and says this is what you're going to have to repay, and here's the schedule of repayment, and here's your interest. Debt financing has a major advantage in that its interest is tax deductible. Not the debt, but the interest. Indenture terms, this is the agreement of the bond at issue, secured. Again, we're backing that bond with something unsecured, only by the reputation of the company. Equity financing is different. We could sell shares in the company. Privately owned company may not issue shares. It would be a share in ownership. We can take what we've earned. This would be profit after our net profit after everything's been paid, and then reinvest that. That's equity. We could attract venture capital. That's asking somebody to come in and give us an inflow of cash. And you'll find this where an investor thinks that the company has a chance to be profitable. Now, there's an issue here, and I want to point this out. Venture capitalists want their money back, and they want it back when they want it back, not when you want to pay it back. Now, that doesn't mean they're bad people. That means they want money when they see the end of the rainbow. They want to cash in. I have a very good friend of mine who's in the home security business and has been for all the years that I've known him, which is quite a number. And he and another friend of his, whom I don't know, started their own security business. Now, my friend has his business now, but this is different. And they got some venture capital money. And they were really going great guns. And the venture capitalist came to him and says, okay, we want our money back. And so they had to pay it. And when they paid it, they didn't have enough cash to stay in business. And they were able to sell and they didn't lose money. But the story is venture capitalists are fine. Just understand they want their money back. And they want it back when they want it back. And then they want it back right now. This is the questions that a venture capital asks. Do we think the company's going to be able to continue and move forward? Want to know, as I mentioned before, when they're going to get their money back, and is it going to be worth their effort, lending the money to something that they're going to be able to get out of it? These are the difference between debt financing and equity financing. And remember, that is the question. What are the advantages and disadvantages of debt financing? What are the advantages and disadvantages of equity financing? And those should be in your own words. And finally, recent financial recession was the worst we've encountered, financial crisis we've encountered since the Great Depression started this month in 1929. We've had a lot of sweeping financial changes, and the government is increasing involvement and intervention. So those are all things we have to be concerned about. That brings us to the end at 5:57, to the end of our presentations tonight, chapters 16, 17, and 18. We will return next week to do chapter 19, when we will talk about using security markets for financing and investing opportunities. And then finally, we'll finish up with chapter 20 next week, which is on the Federal Reserve and money. So I thank you for your attention. I will have this recorded and uploaded for you as soon as possible. Thank you for your attention, and good night.